Welcome, everybody. April 17th, the market update desk with Scott Riley, NMLS number 157524. We're getting close to being at the end of a short week in the bond market and stock trading with Good Friday coming up tomorrow and closing early later today. So, one of the things we had the other day was retail sales. Weren't quite sure where this was going to be. So, it looks like retail sales came in at up 1.4%. That was slightly better than the market forecast at 1.3%. Now, autos in particular and auto parts rose a whopping 5.3% month over month. This is a huge jump, but when we look at it, we know that tariffs are about to hit. So a lot of this increase in headline retail sales and specifically auto and auto parts jumping is because of the full pull forward of purchasing. So that does mean that we need to probably temper our expectations for forward reports on retail sales because once again a lot of that was pulled forward. Now the bottom line, it was a pretty strong report, but when we look at the totality of not just today but the forward looking research, we're going to probably get, like we said, weaker as we move forward. Industrial production and capacity utilization, interesting data that came out yesterday, showed that industrial capacity actually grew. In other words, the amount of unutilized space in factories grew, which is a foretelling of possible recession. Now, what's interesting is if industrial utilization is under capacity, you're probably going to see prices decline because companies are going to still want to produce things and they need production. So if that's the case, we might see a little dip in inflationary cost on some of the goods and services. So we're going to watch that pretty closely. It's kind of an ancillary effect of it, which most people don't quite think of. But if we have less capacity, less usage, it's going to probably mean potentially some lower prices. Yesterday, we also had a 20-year bond auction that came in a little bit better than expected. Once again, non-direct foreign investment was higher than average. So when we look at the potential of people fleeing our bond market internationally, it's just not the case when you go to the raw data. Now, we did have a wonderful speech from Chairman Powell yesterday, and the bond market really wasn't a fan of it because it turned out to be a little bit more hawkish than what the expectations were. When Chairman Powell went through his speech, they're going to be more concerned, it appears, on the inflationary front rather than the labor front. Remember, they've got a dual mandate. Price stability and maximum employment. Now, this is a little bit contrary to what the history has been with the Fed. Now, he also, what the stock market didn't like, he also said the Fed wasn't going to come running to save the stock market if it falters. So that was kind of a shot across the bow. Now, President Trump did post on social media, as he often does, said multiple things, but he focused on Powell's need to cut rates and that his term can't come soon enough to an end, Chairman Powell. Now, Chairman Powell is legislatively in his position until May of next year. Now, on the home builder front, we saw home builder expectation rose 1 point to 40. Now, in a deeper dive of the metrics, we saw current sale conditions rose 2 points. Sales expectations fell 4 points. And a lot of that has to do with inflation and tariffs. Buyer traffic actually rose 1 point, which is not unusual for this time of year. With a report, while the report showed a little bit increase in buyer sentiment, it did continue to be somewhat weak. When builders don't know what their costs are, meaning tariffs, they get nervous and start to pull back on production. The issue is we're already light on production to demand. So right now, household formations are going to be a run rate of about 1.8 million. for the calendar year, and the expectation of home builders is about 1.3 million in home construction. So we see this divide continuing to happen from supply and demand. What's that going to mean to existing home sales? Well, it's probably going to push up the price of existing home sales because not as many people, there's not going to be as many new home on the market as what supply needs. So overall, probably values are going to continue to move upward. Now, one of the things builders noted in the report was the average cost of tariffs for increasing construction is going to be about $11,000 on the average home. Now, home permits were slightly better than the month over month number from the previous month. But keep in mind, that's the maximum number of homes potentially to be built. And usually it's going to be a little bit less than that. The majority of the starts are going to get completed, and that fell. Home starts fell from 1.49 million to 1.32 million. Like we talked about, that spread of inventory to demand is getting wider and wider. So the amount of houses getting completed on an annual basis is about 1.55 million. Now, initial jobless claims that actually fell 9,000 to 215,000, but we did have a bump up in continuing claims, and we showed weakness in the job market for people finding new jobs long term. That increased 41,000 to 1.885 million. On the technical side, we're seeing mortgage-backed securities now trading in a range of support between the 100-day moving average and the 200-day moving average. Now, we've tried to bounce up against that top level resistance and have been rejected from it for a second day in a row. So we'll have to follow. And a lot of that has to do with going into a long holiday weekend. The traders start to pull back. 10-year bond actually closed right on its 25-day moving average yesterday, and we're sitting at about 4.2977. Once again, in this narrow channel of trading. Expect that to kind of continue, maybe retreat a little bit as we go into the long holiday weekend. Hopefully you find this valuable. Do us a favor, like, share, comment on all of our socials, Facebook, YouTube, and Instagram under the Market Update Desk. Scott Riley, the Market Update Desk is your original singular market news source for West Michigan. Give us a call, 616-293-2189. We'll help you get pre-approved for your next home and get you in the right product and help you understand the market conditions. Have a great afternoon.